Good morning and welcome to FBN Forward Markets. My name is Brian Como. Today is the 30th of June. All right, we're going to get started off today. We're going to talk a little bit about soybeans, the soybean corn spread, pasta prices, Australian barley. We got lots to talk about today in a short period of time here. So we're going to start off with the futures today. We've got a little bit of a rebound in some of the grains and oilseeds today. We've got corn up 3 at 489 and 3/4. We've got Chicago wheat up 7 at 607 and a half. We've got Kansas wheat up 2 1/4 at 731 and a half. Spring wheat is down 2 1/4 at 783 and a half. Oats are up 3 3/4 to 520 and a half. Soybeans are up 6 at 13.98, still trading a little bit below 14 there. Canola is up $3 at 814.80. Soybean oil is up almost a percentage point at 63.87. Soy meal is down $1.60 a ton to 413.50. We've got some small gains in the crude oil market, some losses in the US dollar index trading down to 103.16, and a small gain in the Canadian dollar trading at 73.86. We are seeing a bump in stock markets today. As actually, I was just watching the tape. There were some GDP numbers that were amended this morning that would suggest that second quarter business growth was lower. I think that's lowering the appetite for future rate hikes, which is keeping some support under the stock market at this time. So that just crossed the tape just before or just as I was writing this commentary. All right, we're going to get into soybeans to start off with today. Soybeans are up in overnight trade after first pushing lower to fill the gap created on Monday. The market is still moving higher by technical definitions, but we are moving closer to as we move closer to the 1435 previous July high, we still want to continue to reward this rally and take some risk off the table. So we may be looking at doing that pretty soon. We're also seeing that the bean to corn ratio has reached some highs not seen in a number of years. This does signal that soy supply concerns outweigh that of corn, but of course, that's not new news. What this may mean is a shift to more soybean acres in the next U.S. planting campaign, as August prices tend to be where some of those decisions are made. It may also mean some spread traders have or are making bets that the ratio will come back towards normal and would involve a short in beans and a corresponding long in corn. Estimates are that speculators have bought about 6,000 contracts of corn since the last commitment of traders report cutoff. And of course, the end of the last trading session was the cutoff for the next report, which will be due out on Friday. Low Mississippi water levels are raising red flags for U.S. soybean and corn exporters. Low water levels in the Mississippi waterway in the U.S. are again raising red flags for the country's Gulf export hub, a key source of soybean exports, was told AgriCensus this yesterday. While water levels are near historical lows for August, September, and weather models calling for dry conditions through the coming weeks are adding further concerns and feeding into barge premiums that have been rising sharply since the end of last week. There's a quote here: "I suspect that freight is the driving factor for rising barge premiums with freight sellers perhaps nervous that water levels could continue to drop, with the forecast for the first half of September remaining dry for most of the Midwest." That was President Diana Clemma of the Grain Service Corporation, quoted to AgriCensus. The situation in the Mississippi barge market has the potential to jeopardize U.S. Gulf export competitiveness on a FOB and CFR basis as higher costs are passed downstream. Soybean FOB front month premiums in the Gulf increased about 17 cents a bushel between Wednesday and Monday, while CFR China premiums for beans originated in the Gulf lifted about 30 cents during the same period. So generally, this is a bearish input to farm gate prices, as it raises the possibility of demand that would have to be sourced from the U.S. moves to other suppliers as those FOB and CFR prices move higher. It kind of prices U.S. beans out of the market, or if it's easier to source from other origins, it may pull from other origins as well. Either way, the risk is a rising U.S. ending stocks number if we aren't able to meet our export projections. Corn saw a setback to its last half of August rally yesterday, trading in a wide range that tested lows of $4.85 and highs of almost $5. Does that mean that the trade is reluctant to rally corn above $5? That may be the case. U.S. weather means much less for corn right now than it does for beans, with harvest of corn already underway in some states. Fundamentally, corn still tilts bearish with large U.S. carryout expectations. Some hopeful market participants are hoping for a larger cut to corn conditions in Monday's crop progress report, which disappointed with this week's results. First vessel of Australian barley loads for China, almost 1 million tons sold so far. The first vessel of Australian barley heading to China has been loaded after import restrictions were lifted on August 4th, while the total amount sold is estimated to be about 1 million metric tons. Trade sources said that the overall some 700,000 to 1 million metric tons of old crop and new crop barley have been sold to China since the restrictions were lifted, which includes previously signed deals for optional origins, so they're kind of stealing from other origins as well. In 2020, China imposed an 80.5% import duty on Australian barley, effectively blocking imports from the country. But in April of 2023, it agreed to review all of its tariffs, and within 3 months, leading the Australian government to suspend a dispute it had lodged with the World Trade Organization over the duties. China also imposed an additional 3% import tax on Australian barley in 2020, putting this origin in the same position as other origins from which China imports. However, with the elimination of the restriction on August 4th, the 3% import tax was also canceled, putting Australia once again in a more beneficial position. China is one of the world's leading barley importers, with annual imports of 7.2 million tons on a 5-year average basis, and Australia's share was the biggest before the restrictions came into force. So for Canada and for our Canadian clients, that means that there may be some lower demand for Canadian barley into the Chinese marketplace. As a bit of a juxtaposition, high pasta prices set to boil over as Canada's wheat withers. Pasta lovers must embrace to pay even higher prices for their favorite dish, as drought in Canada and bad weather in Europe damages crops of durum wheat and reduces supplies available to flour millers and food companies. Retail pasta prices rose about 12% this year in Europe and 8% in the United States, according to market research. Prices from another staple, rice, have also spiked following export curbs in India. The International Grains Council forecasts the 2023-24 global durum production at a 22-year low, pushing world stocks to their smallest in 3 decades. You can see some of this play out in the Saskatchewan cash price. These are Saskatchewan prices of durum. Saskatchewan, of course, is the largest producer of Canadian durum, the largest province of producer of Canadian durum. Average prices in Saskatchewan reached $529 per ton last week, which translates into about $14.40 per bushel. Of course, this is an averaged value and doesn't reflect, exact elevator bids, but these values will be updated tomorrow. I think they get updated on Thursday sometime, which may actually reflect some further increases. Wheat prices took a hit yesterday, falling below support and trading to new lows into the close yesterday. This likely signals that the market is willing to take wheat values lower before finding seasonal bottoms. There has been some recovery in the overnight markets, with Chicago poking its nose above the 608 waterline, but Kansas, or hard red winter wheat, has not been able to bring values back to the support broken yesterday. As you can see, this is a monthly chart of Kansas, and as you can see, the support break this month on the monthly chart opens up wheat to a much more aggressive sell-off. So these wheat markets, particularly the charts, do not look bullish. I think that there's now a possibility and possibly an appetite after these support breaches to push wheat lower, as we generally do see seasonal lows in the next few weeks in wheat markets. One thing that wheat still has going for it, though, is that Minneapolis wheat is still trading above support. Canada's wheat crop fell by 1 million tons, or at least it was reported 1 million tons lower than was expected. And seasonally, the next few weeks is where, December futures find a bottom. The question is, how low can values go before it finds the bottom? Is the question. We may be rallying off lows from a significantly lower area than we are right now. Lastly, we'll touch on canola, which saw a large range yesterday, with most of the losses coming before the Statistics Canada report release. This market was able to make some gains off of some fairly bearish report news, but did fade into the close to finish off nearly unchanged. We are seeing slight gains posted today, but for the most part, this week's trade has been fairly neutral for canola. We expect that to continue for the week unless we can see some larger moves in related markets like soybeans or vegetable oils. All right, that's all we have for you today. Thank you very much for joining us. We will see you again tomorrow. Have a great day.